morning, everybody. Thanks very much for joining us. Really great to be back traveling, but also great to be back looking at different markets. Welcome to this online briefing. It's one of around 60 or 70 that we do a year. This time we're particularly focused on France. Obviously, recently an election in France, but we'll be picking up on the market, on the insights. We've got a really super panel here today. So we've got Benjamin Cartier-Bresson, who's head of Paris office for Berlin HIP, Rory Sheard, who's international director for Paris office investment for BNP Paribas Real Estate, Raphaël Tréguier, who's founder and managing partner of Kareg Investment Management, and last but very much not least, Simon Wallace, global co-head of real estate research and strategy for DWS. So lots of different perspectives that we can bring into the conversation. Thanks very much for joining us in the RealX auditorium. On your right hand side, you'll be able to put any questions, and of course the joy of this being live is that you can ask those questions and we'll try and make sure that we can answer them. We're just going to start off with a sort of brief presentation, just to bring out some of the key kind of facts and figures in the market. And then we'll pick those up in the discussion. So over to you, Rory, just for a kind of brief view, I suppose, on what we're seeing at the moment in the market.
Thank you, Richard. So a brief market presentation. On to the next slide. I would start off with some economic context. Are we seeing? There we go. A favorable situation at the start of the year 2022 with positive business sentiment, some political uncertainty, as Richard mentioned, but that's now largely behind us. But we're now wrestling with some new uncertainties and notably inflation pressure, as is the rest of Europe. But GDP is still forecast positive for France, and another positive indicator there is employment. Unemployment rate fell sharply to 7.2% in 2021 and is forecast as stable this year. And if you look onto the next slide, you'll see how the leasing market in the Paris region has been recovering over the last quarters. You have there in purple the total employment, which has been growing and positive, and that we can see historically is well correlated to your rolling 12-month take-up, which you can see in the green. Then delving into the investment market figures, onto the next slide. So in terms of total commercial real estate volumes, last year we finished the year at 27.4 billion. So this was a drop from the peak of the market in 2019 and has taken us back to pre-2018 levels. As we start this year, the first quarter is pretty stable, even slightly above last year. On to the next slide, you'll see how this is spread geographically. Historically, France is quite a centralized market, and the Paris market does tend to make up for over 2/3 of that volume. Interestingly, last year we saw a slightly more balanced situation as people became more selective in the office market, and on the other side, some of the regional cities with balanced situations performed well, and also the logistics, which makes up some of the region's volume, were booming. Onto the next slide, you can see the split by asset class. Typically, offices does tend to make up around 60%, followed by logistics and industrial and retail. We see a retail punching above its weight there in the first quarter, and that's mainly due to a larger shopping center transaction. Onto the next slide, you can see the buyer universe. So we have a very diversified market in France. Funds historically are always very active. The insurance money, which performed or took a slightly lower share in 2021, but that's mainly due to lack of product. And then I would also mention the SCPI, which are a backbone of the the French market, and you can see how they've remained active even post pandemic. Onto the next slide, you have some statistics on capital flows and the nationality of these funds. The French market and domestic players tend to like their market, and they typically invest, represent 60% of volume. But they're not alone. They're challenged by German investors, which have been operating in the market for a long time and are still very active. And then the Anglo-Saxon world, which tends to be higher up on the risk curve, but they continue to target France. Middle East is slightly more modest activity, and Asia, where we saw a big wave of Korean investors pre-pandemic, and we've recently seen a push by Singaporean capital, notably with GIC taking big positions in La Défense, for example. On to the next slide, you have some graphs on the yield environment, which I'm sure you're all familiar with. So we've seen the strong compression in the logistics sector. And I would also mention that the prime office yield, which post-pandemic has continued to fall, and this is mainly due to the strong dynamics in central Paris, where we've seen significant rental growth and structurally low supply. The line which everybody is tracking very closely at the moment is the bond yield, and at this point in the market, we are starting to have quite a few discussions about that line moving up and the spread becoming less important. In the context of those discussions, there are a few themes we like to talk about and to illustrate or to reassure. And if you move on to the next slide, the first one is the fact that rents are indexed in France, and all the indice projections are going to follow some of that inflation pressure, and therefore real estate does provide that protection from inflation. Another aspect we like to throw into these discussions, onto the next slide, are the ESG and environmental concerns. This is becoming a real key in investors' decisions. It's really at the forefront. Funds are making this promise in the context of their capital raising. But obviously, the Paris market is a historical one and a very large one, and there's a real lack of buildings meeting these standards. So that's also creating a lack of product, and in a way, we do believe the best products are rare, and there'll continue to be competition, which should dampen any yield movement on the prime side. And we can see onto the next slide, we've been tracking investment volumes by strategy. And what's interesting here is we can see a reduction. This is for office volumes. We can see a reduction in the share of core assets being traded, and that's not at all due to lack of liquidity or demand, but it's just a notably increased selectivity of these investors. And in cases, it's actually pushing long-term investors that didn't used to take certain risks to move up the risk curve. So we've seen core buyers take on planning and capex risk in selective markets, but notably in Paris, where they feel comfortable. And lastly, our research has carried out some sensitivity on the next slide, which is benchmarking basically the evolution of the French 10-year bond against rental growth expectations and how this affects total returns. And given the current cycle and the strength of the central Paris market, you can see there's quite a healthy buffer for up to 1.5% in terms of the bond yields before total returns would be affected. And that slide concludes the brief market insight.
Great, that's super. Thanks very much, Rory. Really interesting to get that view. Let's just do some introductions. For those who don't know me, my name is Richard Betts. I'm the group publisher at Real Asset Media, and as I said, we run a series of these events, but we also publish Real Asset Insight magazine. And interesting, you discussed there the ESG side, Rory. We also launched Impact magazine, looking at ESG and social impact last year. Let's start with you, Rory. So a quick introduction of yourself and the company.
Yeah, so I sit in the BNP Paribas Real Estate Paris office in their capital markets office investment team, and I've been operating in the French market for over 10 years now.
Great, thanks very much. Benjamin, over to you.
Yeah, thank you, Richard. Hi, everyone. Benjamin Cartier-Bresson. I'm in charge of the French office of a German mortgage bank whose name is Berlin Hüb. We are a specialized lender. We provide senior structured facilities to real estate investors. And I'm in charge of the French market. I've been so for the last 10 years. And we are happy to continue developing the business. So I hope there are a bunch of investors in the audience that I would like to speak with.
Great, thanks very much, Benjamin. Raphaël, over to you.
Yes, Raphaël Tréguier. I'm the founder and the managing partner of Kareg. Kareg is an investment specialist with a strong focus on asset repositioning within the Grand Paris. I've been acting as an advisor for large investors for the last 3 years, and now we're currently in the process of creating 2 investment funds for large institutionals who want to increase their exposure to resi through asset positioning, with the 2 main objectives. The first one is to reduce the cost of creating house. You know, it's the land is very expensive, the construction cost is very expensive, and so we try to keep the development margin in our business plan. So I have to come back to yield they used to see in the beginning of the 2000s, yes. And also our second main objective is to reduce the carbon footprint, because through the restructuring of assets, you keep the existing concrete, and so you succeed in having a carbon footprint which is roughly 30% below what you can have with wood, and 50% below compared to classical process of building. So this is our short presentation.
Great, thanks, Raphaël. Simon, over to you.
Simon Wallace, I'm the global co-head of real estate research here at DWS. This is my 11th year at DWS, and I do remember when I first started, I was covering the French market, so it's a great pleasure to be on this panel today. If you don't know DWS, German asset manager, approximately 65 billion euros of AUM split across North America, Europe, and Asia. We're investing across all sectors in each of those regions. French market, majority of our AUM is based in Paris. However, we are active in sort of the regional cities as well. Recently, very active in the office space in Paris, certainly refurbishment work going on there. Strong focus on ESG, very similar to what Raphaël was saying there, but also in the residential space. Really important part of our strategy at the moment is a focus on residential, and France is no exception to that.
Great, thanks, Simon. It would be interesting, I think, just given your role there, it'd be interesting just to pick up with you, I suppose, some of the key changes that you've seen over the past 12 months, especially in terms of the real estate side, and also how you see France within that perspective, sitting there in London and looking at it from a global investment point of view.
Yeah, it's a very good question, and almost to me the change isn't over the last 12 months, it's been over the last 3 to 6 months. I think on Rory's first slide there, I think he had the words new uncertainties, and I think we're certainly all feeling those new uncertainties at the moment creeping into the market. And I think it's important, look, as I say, we've all been doing this a long time, and we've all gone through a heck of a lot of crises over the last decade or so. So I think it is important that we don't necessarily get distracted by what's going on right now in the market. You know, we have some big shifts: inflation, interest rates, swap rates, construction costs, for example, and just general investor uncertainty at the moment. Look, when we were coming into the start of this year, actually we were expecting recovery and things were feeling good. If you looked at all the survey evidence, everyone was suggesting more money for real estate, a period of further recovery. And there's question marks around that at the moment. But as I say, we've been through these crises before, and it's important for us that we focus on the longer term. What are the longer term themes, the longer term trends that are going on? We've talked about ESG briefly around residential. We like that because these are long-term demographic changes going on. Look, in Paris, major infrastructure projects going on. It's important that we focus there. If I look at the French market in relative terms to the rest of Europe, how we see it from London, as I say, we continue to be active in the French market. You know, the problems that we are facing, or the challenges that we are facing, are global challenges: construction costs, supply chain issues, inflation, interest rates. These are all global issues, and we, you know, that we have to accept as part of our being an actor in any real estate market at the moment. So will we continue to invest in the French market right now? Absolutely. Where do we see themes that we like right now? As I say, French residential, very interesting. Perhaps some of those alternative living sectors as well. Student housing, senior housing, very interesting. But the office market as well. Again, the challenges around office, it's a global theme. You know, work from home, remote working. I think several of us look to be working at home at the moment. But again, when I look at the French market right now, I look particularly at the Paris market. Why do we continue to invest there right now in Paris? Because the fundamentals still remain very strong. You go to Paris CBD, Rory will know better than I do, I'm sure, but vacancy for good quality prime space in Paris CBD, that we're talking very low single digits there. So again, a market that remains attractive.
Okay, great, thanks. Really good to get that perspective, Simon, I think. And Benjamin, just coming to you, obviously you're there in Paris. What's your sense of that? And I suppose in terms of the election, obviously Macron winning again for a second term, does that mean we're expecting more continuity? Was that a positive sign for the markets? How are you seeing, I suppose, some of those changes and where we are in the market at the moment in France?
Yeah, that's a good question. I think I would reiterate what Simon said, i.e. that fundamentals are here, and it brings us a form of continuity. So on one hand, we have a number of things which have changed or which are changing dramatically. I'm thinking of the ESG aspects, which have become a priority over the last 12 months. I mean, we knew the topic before, but now this is really what we look at as a priority. We also have a very difficult interest rates environment, difficult for us lenders, but also for borrowers, because the rates increase that we are seeing now is very sharp. And having to adapt to that in a very short time frame is a challenge, clearly. We have indeed the questions around the office sector that have been lasting for months, and where I'm not sure that we have a clear answer to give. So this is all different, but the fundamentals remain the same, and make the French market as successful as it was previously. I like to underline the fact that we have all turned into very good professionals, speaking about the investors, the asset managers, the fund managers, and also the lenders, so that the old recipes that worked so well in the past still are in force, and then able to make very good transactions, keeping the risk under control, and profiting from the value creation that the French market offers.
And that's interesting. Maybe just coming to you, Rory, in terms of the interest rate rises there that Benjamin's also talking about. I mean, how do you see that? Because there's obviously that, I mean, there was your slide there in terms of the difference still between bond yields, but how will those interest rate rises potentially play out? What's the implications for the investment market there in France?
Yes, I mean, it will depend on the risk profile of assets. I mean, on the core side, the French market isn't very levered, and those long-term investors are focusing on the assets which I think the financial institutions are most comfortable with. Where we're seeing more of an impact is on the underwritings of value-add investors. Where the cost of hedging has gone up massively, and there's that pressure on the finance costs. But the value add deals we've been dealing with, be it in Paris or selectively in stronger inner ring markets, we've been achieving our target pricing. Based on expectations of pricing, which were sort of 3 months ago when we were pitching on these buildings, and I think that also reflects the fact that there is a lack of product, and for the right product, people are still managing to make their underwritings work. But it's certainly polarizing the market, and the assets that are not next to the public transport or in some of these secondary markets. It does pose questions for those that segment of the market.
Okay, that's interesting. And Raphaël, from your point of view, I mean, we'll pick up on the ESG side in a minute, but from your point of view, are we then getting a sort of situation there where you've got a polarization within the market, particularly looking at the office side?
The way we look at the office market is slightly different from most other players, because we have a strong focus on obsolescence, and from this obsolescence we try to find a good opportunity for change of use and crafting a second chance of life for this asset. And so this segment is super huge. If you assume that the lifespan of an asset is roughly 30 years, it means that every year you have 3% of the 50 million square meters of the Grand Paris, which become obsolete, providing 1.5 million square meters to this segment. So what we're going to do with that, for the time being, almost a third were restructured as office. I'm not pretty sure that we will reach such level in the future, because for some of them there will be some kind of a location issue. But I'm pretty sure that the office segment will stay a super good segment. And but the key question is, what are we going to do with the remaining million square meters coming every year, and which represent a huge opportunity of existing building to do something with it.
Okay, that's interesting. And Benjamin, from your point of view, obviously you're having to decide about the financing side for a lot of these assets. How do you see that? Because obviously Paris is one of the largest office markets, but you do also have you've got a lot of older stock as well as newer stock. So I suppose, are you changing your risk assessment as a bank in terms of the financing side there for office especially?
I mean, yeah, we constantly have to look at what the performance, the future performance of the properties that we're financing will be. And on office, I mean, we take for granted that if the location is good, if the property is recent, and in terms of ESG requirements, if it can be put at the modern standard over time, inclusive by means of capex, then we are in a safe haven, really. So what has changed for us is not how should we underwrite an office facility. These are the same criteria that we're considering today as earlier. What has changed is that, and we've seen that on Rory's slides, in terms of where the investment market is, you have a weight of office which is now lower than previously. And we are adapting to that in the sense that we have questioned ourselves, well, should we do other assets than offices, or more other assets than offices than we did previously? And we've started to do so, which means that we are now financing residential facilities in France, including managed residential, like student housings. That's something new, and that enables us to continue make business with the investors who have themselves changed their position.
And just to be clear, Benjamin, is that sort of new development, or is that transformation from office into student housing or residential?
Yeah, that's a very good question. I mean, the overall context is that it's getting more and more difficult to destroy an existing building and then do something new. That's because the pressure from the city halls and behind them of the population and politics is high. When, as Raphaël mentioned, you fully destroy a building and then build a new one, the CO2 consequences are dramatic and cannot be balanced over the life of the asset, even if it's energy compliant, say. So as a consequence, indeed, we are looking and we are financing transactions where the assets are converted from one use to another, but without necessarily destroying the property. So that's something that we see and that we do, and that we will do more and more, I think.
Okay, good. And Simon, looking at your sort of strategy in, let's look at Paris, for example. I mean, I was really interested to see in Rory's slides there the change from over 10 years, from 2012, where nearly 80%, I think it was, Rory, of the investment was in core, and then the huge change around to the latest time, where there's a lot more focus on value add, on core plus. Is that where a lot more of the opportunity is at the moment, Simon? Do you think, in terms of, are you seeing that as well in terms of, maybe it's the transformation of an asset into something that is, is more ESG compliant? Where are you as investors at the moment?
I think it's a combination of factors that have led us higher up the risk curve, particularly within central Paris. I think on the one hand, it is pricing. I think there has been a search for additional return within the market, particularly as we're coming into the back end of last year, when there was expectations about recovery, and recovery was certainly picking up. So to get that additional return, in a market where prime yields were getting down to around 2.5% to 3%, there was that need to take on additional active asset management. I think also because the fundamentals were solid in central Paris, it did allow for that. It didn't seem like too much of a step up the risk curve to take on a redevelopment play within central Paris office, for example, when you see a vacancy rate of 2% and you see continued occupied demand in those areas. And it's interesting to me when I look at some of our recent investments and recent refurbishment work that has gone on, even in this market of uncertainty, we still see occupied demand, and we're actually seeing rental growth within central Paris at the moment. So that best-in-class space that is providing that high level of wellness, ESG, is attracting occupiers who are willing to pay for that best in class space. So yes, we've seen that move up the risk curve. I think right now sentiment has certainly softened at the moment, and I think there are question marks around how much development risk you want to be taking right now, given that exposure to construction costs, for example, or just general uncertainty in the market. But nonetheless, I think in a market with solid fundamentals, taking on more active asset management is not necessarily will continue to be an attractive option.
Okay, good. And Raphaël, looking at the market, I mean, how much of the market is there's a lot of discussion around stranded assets. You're talking about a huge amount of space coming on each year that potentially needs refurbishment. What are we seeing at the moment? I mean, are we seeing some offices, if we've got tenants who are looking for the really great office, what's happening to those offices at the moment that aren't great? I mean, can they all be converted? Can they all be upgraded? What's the situation? Or will there be some assets, rather like the Dutch market, that really you can't do anything with in terms of the office market any longer?
Well, I'm not a broker, so I will let maybe Rory and having a direct contact with the broker on the ground answer to this question. Nevertheless, what we can see is that the situation is more or less linear, meaning the old assets don't have any visits anymore. So what we used to see 4 years ago when we create Kareg is now, I would say, a daily, I would say something we see every day. All the assets we used to visit are now empty, let or not let, meaning that even if people have already still an ongoing lease, if the employee think that it's not a proper way, a proper place to work, they prefer to stay at home. And so I visit every day fully let assets or 50 let assets, but empty. So I'm pretty sure that there will be a huge change there. But again, they will go somewhere else because they can't work at home the full day. You have to remember that most of these people, they have a 200 square meters house. They have a living room, the kitchen, and so they need this office space. So I'm saying we are in the middle of something. We just wait for
we do. That may be coming from you, Rory, is it? That's great. Thank you, Rory. Yeah. Go ahead, Raphaël.
I think we are in some kind of a temporary period where both owners and users are still think about what they're going to do in the future, but in a very now short future, because they can't wait. They can't afford to wait too long now. They had this feeling during the COVID, and they can't afford to have this 12 months, maybe more period of thinking, but now they have to make a decision. And so I won't be surprised that there will be, whatever others says, a lot of vacancy, increasing in some bad locations, but some good locations in the first ring of Paris or in Paris will stay super good. So and so this will create opportunities for I would say agile players.
Okay, good. And Rory, is that what you're seeing in the market as well? That sort of split between what would be maybe now considered a bad asset, if you like, versus everybody wanting to go for something that is ESG friendly, is right next to public transport. Are you seeing a real split in the market at the moment?
There is that. It's back to that polarization, and the Paris market is a very big market. There's this move where the offices, the good offices of tomorrow are much better than the ones of yesterday, and are probably going to be worth more. But it does leave other assets a little bit stranded, and we have seen in the past 6 months we've never had so many situations. We've had a couple of discussions on distressed office properties which no longer can perform as pure office assets, so they're being looked at, reinvented as mixed-use assets, and we're also seeing selectively office buildings being purchased for student housing conversions. We also saw one in the north of Paris, an office building that's been looked at to do last mile logistics. So it's definitely a theme. I think people are willing to see this as an opportunity. Then the constraint is how quickly can the political instances, the political bodies and the local authorities, move, because they've got master plans in their cities and infrastructure issues to deal with. So I think there's the willingness from the investor side to be creative with those buildings, but then the timeline is probably quite a long one. And yeah, that's what I would say. But it's definitely a theme and a growing one.
Benjamin, just coming to you, interesting there from Rory about potentially distressed assets coming back into the market because of this changeover. I suppose partly the sort of drive from occupiers to want to have interesting, great space in order to encourage people back to the office, but also the I suppose the sustainability aspect of each of those and the danger of it being stranded. What's your sense of that? Is there a risk of there being larger distress with, banks being handed back the keys in the Paris market? How do you see that? How do you see that at the moment? And I'd also be interested in picking up just on where you think we are at the moment in terms of green financing and whether that's potentially a solution for some of these assets.
Yeah, that's really a hot question. Will there be a number of investors who cannot repay their loans due to subperforming assets, especially in the office sector? My answer would be that we have all been super professional over the last 5-10 years. I.e. the leverage has been maintained in France at very reasonable levels. And we've been super picky in terms of deciding which asset we would finance and which one we would not. We often heard that the COVID crisis was a simple form of acceleration of trends that were pre-existing. And I think a good illustration is the fact that assets which are today in, say, poor condition and which could trigger issues by the lenders, well, these ones were already in an average, say, position 5 years ago, so that we stayed away from them. So being professional 5 years ago has consequences and probably makes that today, well, our portfolios of loans are really super healthy. That's one thing. And with regards to the ESG topic, I mean, clearly there's so much going on right now. I think we are simply at the stage where we learn what we are talking about, because there are so many different aspects. I mean, just for us as an example, we make the difference between a green asset, a green loan, which is different from a green asset. Usually the green loan is on a green asset, but it's a different concept. And we also have a green source of funding, i.e. green Pfandbriefs, covered bonds, what concerns German Pfandbrief banks. So these are different. The criteria for determining if the tool is green or not are different. You need to understand who sets the rules. By the way, it's usually different depending on who is acting. And on top of it, we have the authorities, so the ECB or the European community, which has its own requirements that we need to consider as well, and which are themselves changing. Taxonomy is something which is not totally stabilized yet. We know that we'll have to comply with it, but we don't know exactly what we have to do. So this will be made clearer in the future. So it's a topic which is so important, and we don't see it as something where we have to, against our will. We think it's a fabulous way to make ourselves more professional, to support, of course, the fight against climate change, most important. And but there's a lot of work to deploy here, clearly.
Okay, great, thank you. And just a reminder, if you've got any questions, please do put those in the chat. I actually got one on my phone via text, interestingly, rather than in the chat, but that's fine. Also, which is just asks about the development side, and just people taking development risk at the moment, particularly with construction costs. I don't know whether anybody wants to pick that topic up. I know in France, for example, there are differences in terms of construction contracts, but is there an issue there with development going on, either from the financing side or from the investors' desire, because of the potential inflation and I suppose the risks around costs? Does anybody want to pick up that point?
Yeah. It's a super interesting, super relevant question these days. We're financing a couple of project developments, and we need to ensure that the costs are under control. The main risk that a lender runs on a construction is clearly overruns, cost overruns. But luckily, we are in a country which is super advanced and super well organized with regards to construction loans. We have so-called VFA and CPI, which are turnkey contracts whereby the construction costs are fixed, as is the delivery date. So that's extremely comfortable. Plus, these contracts are backed by completion guarantees issued by banks. Which make that if there's not enough cash at developer level, then the bank will put the necessary monies so that the property can be completed. So this is extremely secure. This is extremely good, and of course, in today's world, extremely precious. Yeah.
Okay.
And I think, Richard, we've got to see the medium-term opportunity for this for investors. You know, this will likely curb supply over the coming years. You're already seeing a few projects that are being delayed or cancelled outright. And again, across the globe, you're seeing this. And this is one of the key mechanisms that we're going to have to push this inflation through into higher rental growth as well. As I say, in a location like central Paris, which is highly in demand with low levels of vacancy, if you don't see that supply coming through, again, that's likely to translate into higher rents. So let's, as long-term investors, we see this as a potential opportunity as well as short-term risk.
Okay, great. And Raphaël, I wanted to pick up with you. Feel free to pick up on any of the points there, but I wanted to pick up with you on because you mentioned that the transformation of assets. How much planning risk is there, particularly looking at the Paris market? If you're looking to transform something from office to a different use, for example. How quick is that process, and how easy is that process?
Well, I think this is the most relevant question regarding the conversion, because the change of use is usually something which is from a city point of view on a 5 to 10 years time scale. And now we push them to make a decision within a few months, which is investment time scale. So when Rory called me, proposed an asset, and so on, the first thing I have to do is just to pick up the phone, call the city mayor guy. Do you want to change this asset? It doesn't work. And usually he said, usually I take this type of decision within 5 years. Why do you want me to answer within 3 months? So that's an issue. Second, office assets are usually seen as center of profits, whereas house as a center of cost. You have to have public equipment, transportation, schools, and so on. You welcome new people, you don't even know who they're going to vote for, and so on. So it creates not only additional cost, but anxiety at the city level. So yes, it's complicated, but why it's not really an issue of the change of use and asset conversion. Is something totally shared with any developer working on the housing segment, which is really specific to the conversion is the use of an existing structure. But as far as the planning issue is concerned, we totally share that with any developer, like Nexity, Sogeprom, and so on, which make most of the turnover on the housing segment. I hope I answered the question.
Yeah. No, I think it'll be really interesting to see how fast that happens. I'm just thinking in the UK, Simon, where there was an issue to a certain degree with retail.
One of the things we faced over the last 3 years is maybe the lack of mandate from our investor point of view on the administrative risk. A lot of investors have know how to manage the market risk, and I think the final investors also, they benefit from a lot of statistics and intelligence to assess the risk they're gonna take on markets and some markets, but for the administrative risk, they don't have any track record. It's very complicated for them to assess that. And I would say that most of our investors today in France are not familiar with this type of risk. So, and this is totally inherent of the change of use. So we have to deal with that. And that's also the reason why we decide to create these two funds, because we do have the skills in-house. We know how to manage this risk. And so now our battle is to convince investors that yes, it's maybe a new kind of risk they are not familiar with, but it's such a big deal. And what are the consequences in figures on the business plan? Is it a deal breaker, really? Or does it make sense to take this kind of risk? And I think this is really something quite new for private equity investors, something which is not new at all for REITs. When I was the managing director of the CEO of Sheard, which was a big office REIT, I never had any questions from my analysts about the administrative risk. The only question was about the pipeline. Back to the private equity world, this is exactly the opposite. So it's just a question of, I would say, mindset and the way we approach the market, the type of risk we like to manage, and how familiar we are with them.
That's interesting. So, Rory, do you think that means that there's going to be more sort of longer-term investors, who've got patient capital, who can actually look at these markets and go, okay, well, there's an asset there that can be repositioned from, from office at the moment. Yes, I've got to wait maybe for planning, but ultimately that will come through. Is it going to be something more for that sort of patient capital than the opportunistic capital?
Well, I mean, it's definitely a big theme, but I think, as Raphaël said, it's not something which many investors are comfortable with yet. So we're not really seeing yet the vehicles dedicated to it, but it is such a massive pocket of opportunity that perhaps some of those longer term investors will work towards that theme. But for the investors that distribute. And are looking at just safety and distributing their coupon. Obviously, this is too complex. So you know, it is you know, it is a bit of a conundrum, and it's you know, the opportunities there. I think a lot of people find the theme fascinating, but we're at the beginning of something. And I think another issue which we haven't mentioned is obviously, you know, for some of these conversions to work, you know, it's going to take time for valuations to adjust and for pricing to be at the point where these conversion themes can work also, because if you're going in at a lower entry point, that administrative risk is in relative terms perhaps easier to accept.
Okay, that's great. Couple of questions coming in that I just wanted to pick up on. Are any substantial reforms affecting real estate affected in the second Macron government? Was one, and also with cap rates for prime products standing at 3 to 4% and a lot of investor appetite focusing on that segment, would you expect any value and price shift in the foreseeable future, or like for post-Brexit London, just a slowdown of market activity? So I don't know if anybody wants to pick up on either of those.
I can say something about the Loi Elan, which were voted in 2018. The Loi Elan provide a lot of tools at the end of the city mayor to facilitate change of use. And as a matter of fact, they didn't use it anymore at all. But I say not at all, it's not at all. So I think really, I do not expect from this new government a big change on the real estate market. I think the biggest change are already known. We have just to come back to fundamentals like in the middle of any crisis. But I do not expect any dramatic change from laws and change of government in France.
Okay,
maybe I would add to that the fact that we already have laws which have been passed whereby tertiary assets like office assets have to dramatically become more performant from an environmental point of view than they were previously. So that the pressure is there, although we don't know exactly. I mean, guidelines have been voted, like reduction of CO2 emissions by 2030, 40, 50. But we don't know exactly how this will be managed. We only know that this will happen at some point, and the consequence for us as a lender is that we only finance properties where we know that the necessary capex can be completed at some point. Because as Rory said, we are in Paris in a very specific market, which is an historic market. And putting assets at a new standard, which would be green offices, is really not easy, or at least will cost a lot of money. What's good is that the rent level is high enough and the value of the property is high enough to absorb that, but a lot of work will have to be done. So I'm not expecting things to change, but simply to accelerate. And we already know that, well, cash will have to be deployed on these aspects.
Okay, good. And Simon, in terms of cap rates, are you expecting any real changes there?
Immediately taking the status quo, no. So we're not seeing it yet. And actually, we probably saw a little bit of compression during the first quarter of the year. There's some evidence of that. But it is getting more difficult. I think if you asked me that question 6 months ago, we would have expected cap rates to continue to compress this year in a modest way. I think we're revising that and we don't see much further compression. But look, I think right now, the status quo real estate still looks attractive, particularly that point about indexation as well. And we haven't really mentioned that, but as Rory showed in his slide, indexation is such a powerful feature of the real estate market at the moment. We've got to remember, you don't get that in other parts of the world. You don't get it, you don't really get it in the UK, the US, Asia. It's not really a feature. So that's one of the key features I really like about the European market at the moment. I think, though, the one thing we've got to watch out for is that if this tightening and the uncertainty in the market does lead to a greater slowdown, perhaps a recession in the European economy, then that's where I think that combination of higher rates, inflation, swap rates increasing, plus a major slowdown in occupier demand, that's where we could see cap rates move higher.
Okay, great. And Benjamin, just picking up with you in terms of the sectors you mentioned there, the bank moving into areas of like residential, student housing. What's your sense of the sort of sectors overall from your perspective, from the financing perspective, and I suppose as well from what you're getting in terms of client requests? Are you seeing an uptick in retail or hotels or logistics? Obviously, very much a dominant force at the moment.
Yeah, indeed, Richard. What we're seeing more and more is, say, serviced or managed residential, like for the elderly people, for the students, that sort of things, whereby we are not necessarily anymore in pure real estate financing. We also are financing assets which are operated and where the pure real estate, i.e. location component is pretty low. So one has to take care about, is it real estate or is it no longer real estate? And what we see also a lot is life science projects. I mean, we are being asked every other week about a new project. The projects, by the way, look very, very interesting, but it's a new sector, and we need to make sure that we understand it fully. So clearly, that's a trend. What we see also more and more are urban logistics that needs to be financed, which are partly conversion from, like, typically car parks converted into urban logistic assets. So very interesting as well, but need be analyzed very deeply, because in terms of consequences for the city, for the citizens, I mean, it's not easy for the city halls to provide building permits on that. And what else? Yeah, we see requests for landing pads for drones, which is really ancillary, but which looks super interesting as well, frankly.
Great. And Rory, and I'm going to come to everybody in the last sort of couple of minutes there, just for your sort of views on where the big opportunities are. But what are you seeing? Are you seeing more of an interest in those sorts of, what would have been counted as very niche areas like data centers, life sciences, but also areas like senior living, healthcare, those kinds of assets?
Well, yes, there's definitely a willingness to diversify, and some of the questions around offices have kind of accelerated that. But having said that, I do still think the volume and selectively there's still a great story on offices in Paris.
Okay, great. There's only a couple of minutes left, and so I just want to, I suppose, get your sense of location and opportunity. So let's maybe start with you, Raphaël, just in terms of where you're seeing the opportunities at the moment. French market fundamentally good from your perspective. So are you sort of positive on the market, but also where are you seeing the opportunities in terms of the sectors, but also is it Paris or is it regions, or where are the opportunities for you?
In terms of location, for us it's definitely the inner ring of Paris and the outer ring of Paris, but it's more because the office segment is in super good health in Paris itself, and in some pockets like Neuilly, Le Valois, the office market is in very good health. So as far as we look at really asset conversion, it's more inner rim and the outer rim of Paris. We don't look at regions, but it's more for our internal organization point of view. It doesn't make sense for the time being to look at regions, even if it could make sense for bigger organizations than Kareg.
Great, Simon. What's your sort of sense positive on the French market, but also where are you seeing the opportunities?
Yeah, so positive on the French market. I think Raphaël and I are going to compete on office buildings in Paris. I think that's certainly a feature for us. I think, though, outside of Paris, residential for us is the big focus for us. Yes, we do it in Greater Paris region. We do residential, but also some of those fast-growing regional cities as well, the likes of Toulouse or Bordeaux, for example. Interesting BTR opportunities in those markets. Senior and student as well. We've mentioned it again. We could look into some of those regional cities there as well. Very interesting long-term demographic plays going on.
Great, thanks. Rory, where are the opportunities from your point of view?
I think at the moment, and dealing with the uncertainty, Central Paris is clearly a very good bet. You've got your rents index, but also in terms of the cycle, we're still seeing significant growth, be it in the traditional CBD, but also in some of the fringer markets inside the ring road. The demand is definitely there, so that's where I see a real opportunity.
Okay, great. And last but very much not least, Benjamin, over to you. I suppose where would you be investing money, or where would you be, or where do you see the opportunities? I guess from the financing perspective as well.
Yeah, it's a difficult question, really. In terms of location, I'm not sure things have changed that much. I mean, even though you have more and more people living outside of Ile-de-France and doing some home working a couple of days per week, I think it's still important for large corporations, say, to have its headquarters in super good locations in Paris, because that's where the people commute to. And maybe they even need to have better locations than before, i.e. close to train stations or so, which means that I would not necessarily want to go to regions, I mean, unless you have a super good transaction. And I would also probably avoid the suburbs of Paris. I mean, the far suburbs, even if the asset is good, I would avoid. So clearly central Paris, or Paris, say within Paris boundaries. And then comes the question, what kind of assets? There I would seek some diversification. Being understood that, and we haven't mentioned that, on residential, it's interesting because residential is not as easy to manage as a single tenanted office facility, right? So the management costs are there. And clearly the interest of investors for that asset kind partially at least stemmed from the fact that interest rates were super low, enabling to generate some return on these assets, which themselves produce super low returns. So now that the interest rate environment is changing, of course, you need to reconsider that and ensure that it makes sense still. So I'm more asking questions than giving answers, sorry on that. But yeah, as I said, it's not easy these days, it's not easy.
Maybe, Richard, something we haven't talked so much about is the taxonomy impact. This will have, I think, over the next 5-10 years, a huge impact on our segment. Until now, we are trying not to significantly harm the environment, but with the taxonomy and the Article 9, the SFDR, a lot of capital will be redirected to clean funds, which have a positive impact. So something which is a direct positive impact on to the planet, to Earth, and this will be super strong because we have a lot of mandatory disclosure now that will come into force over the next years. We're not talking about in 10 years' time. We're talking about 2022, 2023, and so on. Meaning that all the finance investors who currently think about how I'm going to allocate my money to us, there will be this in their mind. They will need to have a positive impact, and not only trying not to have a negative impact. which is a totally change of mindset here. And so some things like carbon footprint, creating good things for the people and so on will now come into figures. And so the ESG won't be only greenwashing. It will be very understandable and from everyone, meaning us, investors on the ground, the population, the family investors, and so on. So this will have a very big impact on everyone. I think much more than only the location and the segment. It means that tomorrow, when you're going to build a new office asset or a new logistic asset, your final investor and the committee will say, okay, good asset, good returns, but what else? Any good impact? Because myself, at the top of my head, I have to improve these rates in my green barometer. How can you help me to do so? And this will be a new big driver for us as investors on the ground.
Yeah, really interesting. I think how those kind of structural things and the taxonomy is going to be changing that, and that's certainly something we'll be picking up in Impact Magazine for certain. Thanks very much for joining us today, everybody. Thank you for your questions. Really interesting discussion. We didn't pick up much on logistics today, but we have got a session on June the 8th live in London, but it will also be hybrid, so you'll be able to follow that online if you can't be in London, looking at European logistics. That's on June the 8th. Picking up on the ESG topic, we've also got an online session looking at net zero and dealing with that challenge of accreditation. Then on June the 22nd, we're back in London for the Iberia investment briefing, and last on June the 23rd, we've got the European Outlook also in London. All of those will be streamed online as well as the ones that are in person, so do feel free to join those. And if you're joining us on demand, thanks very much for watching. Thank you, everybody. Really interesting discussion, and look forward to seeing everybody who's joined us at the next one. Thanks very much, everybody.